Welcome back. Welcome to the course Commercial Banking and Fintech, and in this course we have covered different topics. Now we are going to enter into a domain of regulations. Why commercial banking regulation is important and in what context you have to understand. So henceforth it is going to be mostly the regulations related to the commercial banking in global setting, and also in the case of India how it has been implemented. Mostly we will be looking at the Basel norms, Basel 1, Basel 2, Basel 3, and in this particular session I will be also giving you some background that why banking sector regulation was needed and why we had the different Basel norms, what are the different measurement requirements and rules on governance and standards that banks have to follow, and why each and every central banks becomes part of the Basel norms. So, as we have understood from the very basic idea that when we assume that the commercial banking is mostly focused on in building up different types of rules and governance. So, if you have to go about commercial banking, we have a fractional reserve banking, this is what we can say. So, one regulation that comes with the commercial banking is the fractional reserve that they have to keep, but commercial banks are meant for taking deposit and lending, right. And this way we have said that this is the asset and this is the liability, right. Once I have told about asset and liability, so on the asset side we know that it can be an impaired asset, right. For example, bank have gone for lending and it has become NPAs, or banks have gone for evergreening. So, these things we have discussed already, right. So, these are the loopholes. On the deposit side also we can say, on the liability side also, if I have to put on the, so if banks have less interest income, so net interest income of the bank is not that high, it is having issue with this, then as a result the bank will be start selling the asset, and if it is selling at discounted rate, then this leads to what we call it as the bank run, right. So, overall what it comes out that the NII that I mentioned here, it has a lot of the positive effect as well as negative effect, and we have the case in case of Diamond and the Big model, we learned that how the bank run happens. So, a regulation was required because all these banks, if they are going for risky investment, and this risky investment is ultimately turning the need for recapitalization. So, which government is always going to safeguard the banks if they are incurring losses. Recapitalization has lot of taxpayers money getting used for money is being used. So, this becomes a controversial topic. So, as a result, why can't we go for ex ante kind of setup, right. Before the realization of these shocks, better to have regulations. So, one aspect is that. Second aspect is the globalization. So, when global economy, if you see the trend in the global economy, we had the era of 60s, 70s. So, in the policy setting in macroeconomics, we say Bretton Woods, pre and post. Why Bretton Woods? Because 1944 back, we have created all the global leaders sat for setting up three critical institutions, which was like a GATT, General Agreement on Trade and Tariff, IBRD, that we call it as the World Bank. Then here we had IMF. All three institutions were set up. But one of the important things that happened in the Bretton Woods Agreement was all the countries agreed to have the fixed exchange rate. So we had gone for setting up the fixed exchange rate, and it was having linked with the gold also, fixed exchange rate. Certain 1 USD was equivalent to certain ounce of gold. So this particular system continued, a fixed exchange rate. All countries were supposed to have some kind of pegging their currency with the dollar, and the Deutsche Mark and the pound. At that time yen was not that much popular, but all these countries lobbied to have more dollar. But as the US started facing the external debt, and by 1970s, by mid 1970s, we saw that there was collapse of the Bretton Woods Agreement as countries moved away because of the Soviet Union pressure and other Cold War situations. US had to face a very embarrassing moment, and then ultimately countries moved away from Bretton Woods Agreement. And post 1970s, we saw the emergence of what we call it as the euro dollar, right. So euro dollar is basically a kind of a deposit that you keep in dollar terms, not in the US, but in some other locations, in some other countries. So as a result, one important segment of the financial market emerged, what we call it as the forex market, right, foreign exchange market. And this market gave a rise to a lot of transactions, the volume started rising, and banks were allowed to participate. So as a result, you can think about the exchange rate, if it is going to be decided by the banking sector transaction. So you can think about the transaction in terms of different foreign currencies, and at the same time the impact on the domestic liquidity, there will be need of sterilization. So whole lot of macroeconomic issues, but the idiosyncratic issues were also raised, that some banks were participated in the forex market, and these banks did not do well. They betted against the particular currency, and they were not correct or accurate, so incurred huge losses. And this created the need for a global regulation in the banking sector, and that led to the establishment of banks for international settlements. And Bank for International Settlements, based in Basel in Switzerland, became the global regulatory body, and all the major central banks were part of it. Has more than 70 countries as the member, and BIS, that we say, Bank for International Settlements, became the hallmark for global banking regulation. But then came 2007-8 global financial crisis. Now global financial crisis again opened the door for further regulations. So different versions of Basel was already operating, but then we had the Basel III implemented post that, and a lot of countries require different types of buffers and counter-cyclical buffers. So post 2007-8 we saw a major change in the global banking setup. So with these things in mind, I thought let's have the proper idea about why we should be learning the commercial banking. So let's go one by one. So chapter 15 in the Hull book, it is very interesting, risk management and financial institution, and this book has a lot of insights, and based on quant you can read about it. Then Mishkin is also a very good reference, and Fragziak is of course for micro foundations, and some of the normal pages available on the RBI is also equally helpful. So let's understand the global, why we need global banking regulation and why we have to think about it. So here we have, so first is the rapid growth in cross border lending. So that way I told about globalization, that globalization created this scenario. So and then wholesale funding market started. So countries, so banks formed the consortium, and they started lending to, getting into what we call it as the syndicated loans. So this also became a challenge. Banks started helping banks or firms in external commercial borrowings, basically external borrowing you can say. So this also started getting attention, right? So when the banking sector started participating in different activity, not just the accepting deposit and lending, then the regulation need was. Then multinational banks started operating in different countries. For example, HSBC, Deutsche Bank, your Bank of America, you have a Barclays. All these banks have multiple offices operating in different countries, and this whole operation based banking, mostly we call it as global banking. When global banking, when it started operating in different jurisdictions, which means that when you are operating in India, Indian law will be applicable. When you are operating as a foreign bank in some other location, then that country rules and regulations will be applicable. So that also created a lot of confusion and arbitrage. So countries which are having a very relaxed kind of norm for domestic banking as well as foreign banking. So then banks were allowed to operate from there. Some of the banks also looked for holidays, tax holidays. So there, wherever you have a minimum tax on the earnings of the banking, then some banks started moving to those locations. So this created confusion, and then there was need for unified framework so that the global banking system can have the uniform standards to whatever in possible ways, and then they should not also compromise the heterogeneity of the domestic regulation. So that was the purpose. Interconnected balance sheet in HSBC operating in India, it will have the component in the global balance sheet that it prepares. So this also creates the shock. A lot of time we hear that when the investment bank like Lehman Brothers collapsed, it has this rippling effect on other nations, and this created the whole lot of what we call it as the systemic risk and contagion. So here you have interbank exposure, forex settlement. So FX is basically forex. So capital market is for long term borrowing, money market is for short term. So when you want to list your company in the stock exchange, then bank can help you, bank can guarantee. So all those kind of issue of the corporate debt, it also started and somewhere managed by the banks. So bank started offering, when they started offering host of services, then the need for regulation started. And it was also found that national supervision, which means that the domestic regulations were not just sufficient for those banks to operate, and the heterogeneity in regulations created a lot of confusion, possibility for arbitrage, and some banks had very tough time. Some banks had very aggressive expansion. There was a need to protect the interest of small investors, small depositors. So then this need came out. Bank shift activities to, so this is linked with the second point. So bank also started getting attracted to regulated jurisdictions. Then race to bottom. Race to bottom is when countries, in order to compete for foreign capital, they try to compromise on the regulation side, and they make more flexible regulations so that they can attract more capital. But at the same time, it becomes like too risky in some cases, and a lot of time it has happened that countries have experienced high uncertainty and volatility in asset market, capital market, and others. 1997 East Asian crisis is also one of the contributions in that context. Then here we have the 1970, we saw the collapse of the Bretton Woods agreement. So exchange rate volatility went up because countries moved away from pegged and fixed exchange rate to flexible and managed floating. Oil price shock that we saw due to the OPEC countries, and OPEC countries also allowed the large capital inflows or outflows because of the unprecedented demand that had come at that time for borrowing and lending for buying the crude oil, which were trading at a very high prices. Then euro dollar, as I mentioned, offshore banking markets, global banking that I mentioned. So all these are the regions. In 1974, there was a very good case for Bank Herstatt, you can say it was the German bank, mostly exposed to the newly opened forex market, and this particular bank had a tough time, and ultimately this bank had to go for the so a lot of time we mentioned in forex market Harstadt risk, because Harstadt created that kind of scenario for loss, because they were betting and those bets were not successful and not appropriate, and because of that this led to the failure of the bank, and finally they had around more than 2 billion of Deutsche Mark at that time. At that time there was no euro. Germany now has the euro, but at that time it was not. And then also it also mentioned about the cross border settlement risk supervisory norms. And finally in 1974 the global leaders created something called Basel Committee on Banking Supervision, and it was mostly to harmonize capital standards and improve supervisory cooperation. After 2007 at global financial crisis, we also saw major change, and that was for creation of excess reserves in the form of countercyclical buffers. And we if you go on the RBI website, you can see that they publish a 6 monthly or so the financial stability report, which is a new thing. Earlier it was not there, but it has come only after 2008 global financial crisis. So Basel I was set up in 1988, and then we have different types of capital frameworks that we have noticed. So bank charge Harstadt was this. So German bank failed settling the foreign exchange transactions, and it occurred because it was having the US at that time the Deutsche currencies transactions, and there was a issue of the counterparty risk, because the betting so sometime when you bet that the rupee will the Deutsche Mark will appreciate, but it depreciated. Sometime when you expect that it will depreciate, it appreciated. So that kind of scenario, and ultimately created loss for international counterparties, and ultimately it has to experience the bankruptcy, and this created the whole lot of the international contagion, so a spread of shock from one market to another during the crisis period. So this is what we define the contagion, or you can say financial contagion. So this also created, and there was need for the international supervisory. And also we had the inconsistent measurement of credit risk. So this was also, banks were shifting to some sensitive locations which were giving tax holiday and less burden. Competitive distortions was also mentioned here, and race to bottom in capital standards also created. So regulatory arbitrage was the reason and need for harmonized global rules. So these two conditions were help. So some banks were using the regulatory arbitrage, and some banks were. So regulatory arbitrage basically led to the global development of global rules and governance. So this is what we imply here. So in 1988 we implemented the Basel norms, and as I mentioned that in 1988 only the Basel norms was implemented. In 1992 it was implemented in G10 countries, and then India adopted around Nasimum Committee report 1993-94, and the major challenge for the Basel I, or the major recommendation of the Basel norms, was setting up the capital adequacy ratio, which was 8%, but Indian government because banking sector comes under RBI and majority of the banks are regulated, so then they had put the capital adequacy ratio numbers higher, so that even though the global standard is 8%, Indian banks will be having 12% or so. So this was, in some cases it was 9% also, and it varies between 9 to 12. In somewhere you also find 10 to 12%. So this was the case. So capital adequacy ratio CAR was basically defined as tier 1 plus tier 2 capital upon the risk weighted assets. So minimum that was 8%, and tier 1 it was 4% of the core equity whatever the company has, and the tier 2 was kept at the tier 1 level. So 4% you can say again, and Indian government adopted slightly stricter norms, because already the banking sector was facing a lot of regulations, and they were already adopted to the government stricter government regulations in India post nationalization 1969 and 1982. So then for the Indian government it became quite easy to implement in a stricter way, that how they can implement this. So let's get into the risk weights. So for example, in Basel 1 there were 4 important categories. So one was the interbank exposure. Suppose risk weighted asset that we are calculating. So risk weighted asset can be, so sovereign debt, it has 0% weightage because it is already tax free, or it is risk free, you can say. So this is also risk free, right. Interbank exposure, it is risky, 20% weightage was given, 50% if you are offering residential mortgages, and 100% if you are having the corporate loan. Now what was the problem, that earlier majority of the firms were having the same kind of weightage, but then in most of the scenarios we found that these weights were different. And in risk weighted asset, in some cases it was also observed that in case of corporate loans, 3A rating and all, even though the firm is risky, it has the weight of 100%, and this also created a too simple and a risk mismeasurement kind of setup. So let's understand in a very simple way. Suppose Basel 1 assigned fixed risk weight to asset categories, and this created incentive for banks to restructure portfolio without necessarily reducing the true economic risk. So here we have, suppose a bank holds rupees 100 crore of 1000 crore of corporate loan, and there is 100% risk weight. A regulatory capital is 80 crore. Okay, so 8% only, right. So this is what here we have the 8. So 10% of 1000 crore is 100, 8% is 80 crore, and minimum CAR requirement is 8%. So here what is the CAR before securitization? So a bank securitizes the corporate loan and replaces it with the OECD sovereign bond. So suppose it goes by this criteria. How can we calculate the CAR before securitization, and what is the CAR after replacement? So this we can, so before securitization how much it is? So it is just the 8%, and after replacement, when a risk free asset, so it is having the, it replaces with OECD sovereign debt, so it has the 0% weightage, so risk weight is 0%. So you can see that after the replacement, the risk weight is 0, and as a result your CAR is nothing but it is infinity, right. So this is what we often show. So risk unchanged economically, you can see that it has not changed, but exposure remains versus grant. So this is what we saw, that in some banks through regulatory arbitrage they were able to forego the 8% burden, and they were not complying with it, and this was also the loophole for the banking system. Suppose in the second case, bank has the mortgage of 4000 crore and then corporate loans of 4000 crore, and with has the weightage of 100%, and capital it has the 600 crore. Then banks shift rupees 2000 crore from corporate to mortgages. So banks can do this arbitrage. So it moves, what is the new CAR? So this we can easily see that initial RWA was 0.5 and here it is 1. So it comes out to be 6000 crore, and your CAR, if you calculate, it is coming out to be 10%, you are able to meet. But after mortgage has been merged of 2000, so here you can see 6000 into 0.5 and 2000 is 200, this is what we get. And what you are seeing is that basically the firm is able to show a higher number without doing much of the efforts, and this so capital remained the same, risk possibility also changed, and this what it leads to the capital adequacy ratio improvement, and this is what we have the regulatory arbitrage effect we often say. India's Basel I adoption, if you see, so India adopted the Basel I in 1990s, and at that time it was kept as the 8%. But what happened that since Indian banks were having the very limited type of regulation at that time, so this created a good supervisory role and acted as a supervisory role for most of the Indian banks, and as a result the transparency improved, and this also strengthened the overall balance sheet problem that we saw post global financial crisis. And we noticed that majority of the Indian banks were able to maintain the CAR of more than 10 to 12%, and overall what it appeared that the Basel I had created a good sense of understanding for most of the banks, and the Indian banks were trained for the first time in the global banking framework, and it also helped the regulator like Reserve Bank of India to train the banks for global banking supervision. So, in next slide we will be discussing about the further angles of the Basel I. So, overall let me summarize. We covered in this particular slide about the need for the global banking regulation, and we saw that how turn of events created favorable scenario for global banking, and it also added further dimension to the global banking with the additions of certain cap, like for example capital adequacy ratio. In India, when it was implemented during mid 1990s, it became a quite an important avenue for the Indian banks to learn from in the hindsight of the global regulation and work on the governance standards as supervised by the Reserve Bank, and overall the commercial banking outlook improved, and this created a good sense of confidence of depositors as well as savers, as they were having full confidence that banks are operating under the global watchdog, which were the banks for international settlement. So, with this I am stopping it here. I hope you are enjoying the course. Thank you. Thanks a lot. I appreciate your attention.